Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Happy St. Patrick's Day. We're helping you celebrate by going to Ireland, talking with Dubliner Alan Dunne. Alan is the CEO and founder of Archive Capital, who focus on research into managers in the commodity, vol, trend, and macro space. Right up our alley. This was a great chat with Alan on the current craziness in commodity markets, how macro traders have evolved over the years, and why warts are a good thing in a trend manager's track record. So grab your green beer and let's send it. This episode is brought to you by RCM's Managed Futures Group, whose experienced team has been helping investors vet commodity and trend managers for 20 years. Speaking of those trend managers, with all the moves in commodity markets lately, go check out our trend following white paper at www.rcmalts.com, then the education tab and white papers link. Back to the show.
All right, happy St. Patrick's Day, everyone. Actually, we're recording a week ahead, but it's going to be released on St. Patrick's Day. So happy St. Paddy's Day to our Irish guest, Alan Dunne. How are you, Alan?
Great, Jeff. Great to be here on St. Patrick's Day, even though we're a little bit ahead of time. Who better to have on St. Patrick's Day?
Exactly. Well, it's great to meet you. I've been a fan from afar and heard you on Top Traders Unplugged and whatnot. So good to meet you. What's the holiday like over there in Ireland?
It's actually a big one this year because with COVID, there was an extra public holiday allocated this year. So that's actually coinciding the day after St. Patrick's Day. So it's a mega holiday weekend. So it's going to be a pretty big weekend. And you've got the Six Nations rugby culminating that weekend too. Mightn't mean a whole lot to you guys, but it's a big deal if you're a rugby fan in Ireland. And you've got a host of things, obviously St. Patrick's Day celebration. So it definitely will be a big weekend in Dublin.
Who are the Six Nations that participate?
That are Ireland, England, Scotland, Wales, France, and Italy. So
nice. You keep the Kiwis out of there, so someone else.
Yeah, we play the Kiwis and the Aussies and the Springboks typically in the autumn. They tend to come on tour here, and it's good chance to see who's kind of in the ascendancy outside of the World Cup. They don't tend to play the Northern Hemispheres and Southern Hemisphere teams that much. But the Six Nations, it used to be the Five Nations. It's been going back many years, and it's kind of the big domestic, or I suppose, big Northern Hemisphere rugby championship.
Fun. I'll look for the results. How's Ireland's chances?
Pretty good. I mean, we've got that'll be the final round, the St. Patrick's Day weekend. There is rugby this weekend. Ireland are playing England, so obviously the result of that will be out when this is out, and then Ireland plays Scotland in the final match. So it's they tend to be pretty good social events too. But the rugby is pretty exciting too. So looking forward to that.
Love it. And where in Ireland do you live?
So I'm living in Dublin, pretty close to the city centre. I actually, if I looked out my window here, I'd be able to see the Aviva Stadium where they play the rugby. So I'm very central and. Very, very well set up for all of that.
I've never been, so I got to come visit. It's on my list.
Absolutely, yeah. No, if I'm not so much a golf fan, I'd probably be about a 36 handicapper or something like that. But if you are a golf fan, you definitely find lots of great courses over here.
I love it. So let's jump right in and talk about the crazy volatility in commodity markets past few weeks. What's jumped out to you most watching this price action?
Yeah, I mean, it's interesting. It's we were chatting just before we came on. It really feels like kind of once in a generation type of price moves. When I started off in the industry in the 90s, I was a trader and an analyst back in Bank of America in the mid 90s. And when you started off in trading, you read lots of books as to try and figure out how to try and make money trading. And one of the first things I read was Market Wizards. And when you read those books, people are talking about the crazy moves in commodities in the 1970s and trading those markets, and the market being up limit up 5 days in a row. And you think, oh yeah, that's great, but we'll probably never see those kind of markets again. But here we are, and we're seeing them, and we're seeing those kind of crazy events. Obviously, we've got a humanitarian tragedy and catastrophe going on in Ukraine. But I think if you were to go back 3 or 4 years and say, well, you got to have some strategies in your portfolio that might help you out in times of war or crisis, people wouldn't have believed it. So it is a good reminder that all of these things come in cycles, and just because we haven't seen something in the markets for a number of years, it doesn't mean it can't come back. And I think that's definitely what we're seeing at the moment. Obviously, we've got, I suppose the move in oil is, it's not like we haven't seen something like that before. We've seen crazy moves. We had negative oil prices just a couple of years ago. We had oil ratcheting up to $147 in 2008, only to reverse very quickly. So, you couldn't say it's nothing that we've never seen before, but certainly things like wheat and nickel have been pretty crazy by any standards.
Yeah. Are any of the managers you track tied up in that nickel situation?
Yeah, I was speaking to a manager yesterday, actually, who pretty peeved about the situation. In terms of they had sold some nickel and executed their orders whenever it was Tuesday morning, I think, and so those have been cancelled now. So it's going to be very contentious. It's probably not great for the industry, but we'll have to see how it plays out.
Yeah, my theory. I did a tweet thread on this of like it's basically just. They chose go do a capital call on all the members of the exchange or get everyone upset over a few hours of trading and chose the latter, right?
Exactly. Yeah.
But now it's going to get even worse. If we open limit down, people are really going to throw a fit of like, hey, you canceled my sell at 98,000. Now it's at 28,000.
Yeah. No. I mean, it's the integrity of the market is always what's so important in these situations. So when that gets undermined, it really is a serious issue.
And what is generally the LME's got a great reputation over there in UK?
Yeah, well, I mean, obviously it has been the I've just been reading the history of it, and people making parallels with the tin crisis before, which I hadn't been as familiar with, but I think it's one that's going to be a difficult one to manage, and that's for sure. So I think there's a big reputational risk if it's depending on how it plays out.
What was the tin crisis? I wasn't aware of that one.
Yeah, I just read about it. It was just alluded to as the most significant crisis for the LME since the tin crisis. Yeah,
got it. And how do you view, right? We saw an oil went from 95 up to 130, then dropped all the way back to 105. How do you view trend following, in particular's affinity for these large givebacks of open profits?
Yeah, it's one that it does irk investors for sure. I think, trend following managers deal with this somewhat differently depending on how they approach things. What you have in some instances, but obviously volatility scaling up, managers will in some instances scale back their positions because they're going to size their positions relative to volatility. So that can have a nice feature that can be appealing to investors in the sense that you're taking profit as the market is rallying, as volatility goes up. And we saw that as well in obviously the big sell-off in 2020 as well. If, to the extent you're not doing that, I suppose not just looking at one market, when you get big moves across a number of markets, and then you're inevitably going to have a correction, and you will have a big give back, and it can be a bit frustrating. But one of the big features that you see with trend following is the big gains tend to be when you get that big risk on, and then the market extends, and that's the whole point of trend following, that it is uncomfortable. And people who trade the markets will always say, it's those positions that feel uncomfortable are often the ones that will deliver for you over time. But that's a feature of trend following, that you have to have that risk on. You might say, oh, it might have been better to scale back the position, take profits. But if you mechanically did that would, take out a chunk of the return that you get in trend following over the years. So I guess it's another of the features of trend following's return profile that makes it, behaviorally challenging for people to hold. But it is what it is, and it's just one of the features. What you get in return from that is that very interesting, return profile, that particularly alongside that equity portfolio.
Right, and I view it kind of, the investors view it as a bug, and the managers view it as a feature. So it's like trying to bridge.
That's probably fair. Yeah.
Right. Bridge that gap between the two. And if you did throw a bunch of profit taking on there, it would start to lose its trend following profile, right?
That's right. You're going to lose some of the convexity because you're going to be taking profits, and in some of those instances where you get the big move, so you would have already have taken some profit ahead of maybe the move up from in crude from 100 to above $130. Yes, some managers do. Obviously, managers do volatility scale and effectively take profits as the market rally in a rising vol environment. But it's the flip side is you're not going to have the risk on when you get those outlier events as they're called.
Right, and that can make up for years worth of flat sideways, slightly down.
Yeah,
right,
absolutely, and that's what you're really looking for in the return profile. And and it's like if you look at the periods of where trend following has done well historically, be it 2008 or even 2014, early 2015, you'll see months for your typical trend follower where they're up maybe 8-10% 2 or 3 months, and you think, okay, now would be the time to take profits. And yes, there might be a dip, but then you'll see another 2 or 3 months of double-digit returns. And if you take a profit, that's you're going to take out those really outsized returns out of the whole return series, and your overall return, is going to be much diminished.
And how do you mentioned convexity in there? So do you view the profile more as a long options convex payout type profile or a momentum? Right, it's a bit semantics and all that evolved, right? But if you're on a bank platform choosing risk premium and you might choose momentum, that's a little bit different than convexity, right?
Yeah, it's interesting, and I know this has come up on the Top Traders Unplugged podcast a bit. What it's kind of like what's in a name. Is it just trend following, or is it how much of the return attribution you get, is it just by following the momentum and the trend, or a big chunk of it is the risk management as well. So equally, people say, oh, managed futures is a long vol strategy, and it has comparisons with that. And then of course you'll have periods where volatility picks up and managed futures actually loses money, or trend following loses money. So none of these labels are fully descriptive of the strategy by themselves, but there are elements to them. For sure, part of the return from trend following comes from the fact that there are behavioral aspects that the market tends to be stuck in a range for a long time, and then you get something and a significant event, and what that does, it causes everything to reprice. So clearly what we're in at the moment is a clear repricing event, because a bunch of supply has been taken out of certain commodity markets and people are trying to grapple with a new geopolitical regime. So what happens with a repricing event? It ripples across many markets. So there is that trend following element, and that you can capture. But it's not just that; it's the risk management as well. It's the fact that you stick with those winners and you risk those profits as you go with it. That can generate that convex profile, and then what that gives you is a return profile that very often does well in a rising volatility environment. And actually, some of the best trades, we've been talking about commodities, but it's been, the short-term interest rate markets have been really interesting for trend followers as well this year. Why? Not only have we seen breakouts and trends, but you've seen a massive volatility expansion, and that's a really, really interesting property of managed futures. That when you get that vol expansion, you're into a trade and into a position with a big size, and that's what can generate a really nice return. So there's multiple dimensions to how you describe what's going on in the trend following portfolio, and where the returns come from. And I think that's where some people say, oh, it's just following the trend, or it's risk management, or it's long vol. It has elements of lots of different aspects, so it's more nuanced than any of one of those individually.
And just to dig on to that vol expansion concept, right? If I'm trading whatever, $1 million trend following program in 2-year notes, I want to risk 50 bips of my portfolio on the trade. When vol's real low, maybe I'm doing 6-7 contracts or something of 2 years, right? Then
that's it.
Yeah.
So with really low vol, you can get into a position with a tight stop, and because your stop is so and it's a tight stop because volatility is low. And then if you get a breakout and a volatility expansion, then you're already into the position in large size, but the market is now moving, 3 or 4 times what it had been moving for the previous, 3 or 5 years, and so you're going to have, a really nice risk reward profile.
Right, and I think that's what makes it convex, not just a momentum trade, right?
That's exactly it. Yeah.
Yeah. And then on that topic, what are your thoughts on the managers who do some vol targeting? That's kind of been it's a little bit of a knock on some, right? Of like, okay, if I take away that convexity by doing vol targeting, the vol expands and now I have to reduce position size.
Yeah, I mean, you've got different shades of this, that people will do that to a degree, and that will dampen it. But obviously you will tend to adjust the volatility ex post, so you can still capture those periods of volatility expansion. I think you have had historically philosophically different approaches, and trend following has evolved in different ways. You've got the turtle trading type approach, of risking a certain amount on discrete bets, and doubling up and managing the stop losses on kind of on a position by position basis, versus the more holistic, managing the risk in the overall portfolio, and looking at the risk and volatility of that overall portfolio. So that's not to say one is right, one is wrong. They're just they're both trying to take advantage of a phenomenon that people believe is there in the markets, that you get these big moves and trends in markets. But I suppose it's solving for maybe a different utility, in the sense that, okay, not everybody is going to have the appetite to stick with the return profile that you get with the more traditional approach of really running at that high vol. That's not to say that the more nuanced approach of managing the volatility is wrong. It's just saying, okay, we don't want that extreme volatility. We want to, behaviorally have a different type of return profile. So we're going to approach the problem slightly differently.
Love it. We'll get into that in a minute, of maybe you put a portfolio of them together to solve some of that. What are your thoughts on investors looking to add trend or commodity exposure now after such a run up, right? I think back to 2008, tons of money flowed into the space, starting, 2009, when everything rallied back, vol crushed. And 4 years later, you had a lot of people unhappy with managed futures and trend and flowing right back out of the space. So what are your thoughts on, did they miss it? Is it the start of something? Is it that, I know it's an impossible question, but give it a shot.
It is an impossible question. And I suppose, you can try and make parallels, and maybe, is 2008 the right parallel? Even if you go back to that period, we had seen, a good period for trend following in that whole decade. The 2010 decade was a good decade because you had an equity bear market in 2000, 2002. Then you had the commodity super cycle. Was that?
Sorry, yeah, the second bear market again.
Yeah, and then you had a second bear market in 2008, and before that you had a commodity super cycle, kind of 2005, 6, 7. So we had really strong moves in commodities in that period. So, it is an impossible question. I think, at some point, obviously, there will be a give back in this move, but at the same time, if you look back at where we've been for the last 10, 20 years, certainly the last decade was unusual, to 2010 to 2020. From a macro perspective, we had very low volatility in GDP. If you look at US GDP in that period on a quarterly basis, it was between maybe -1% and +2%. I can't remember the exact numbers, but very low GDP quarterly. There was no recession in the whole period. There was no boom. So you had this kind of concept of secular stagnation. So from a macro perspective, it was very slow and steady, not a lot going on in the world. We didn't have an equity bear market in that period. Maybe not so much geopolitical risk. It's always hard to quantify how much of that we've had. But certainly as we moved into this decade, it's been very different. Obviously, we've had COVID, so that precipitated a deep recession and a big recovery. Now we've got, we had started to see volatility in relation to the Fed tightening cycle, and now we've got a war between Russia and Ukraine. So it's already, shaping up to be a very different decade. I think it'd be foolhardy to suggest that we've seen the volatility and things are going to revert back to what it was like for the last decade. I would think a more reasonable expectation would be more volatility ahead. We still have to navigate the Fed reducing their balance sheet from 8-9 trillion, whatever it is. So that's going to be a challenge at some point. They have to think about the timing of that. So I think there's still plenty of risk out there. I think it's a good environment for managed futures and macro-oriented strategies. So I think it is still a good time to be looking at them.
And as you mentioned, macro, what are your thoughts there? Has the world moved away from the classic discretionary macro guy taking a huge bet on XYZ market, and that's more systematic now? Have those worlds have kind of blended?
Yeah, it's interesting. I was talking to somebody about that just earlier today, and if you go back maybe 5 years ago, there was this big interest in systematic macro, quant macro, and we were talking about why was that. It was partially maybe a little bit of disquiet with traditional trend following, and people were saying, okay, maybe quant strategies purely focus on the price are not enough, and maybe there's something interesting in the whole systematic macro space. But talking to people, there does seem to have been more interest in the discretionary macro space this year, and I guess that makes sense in an environment where you get something very different. People might say, well, this is an environment that favors being nimble, being opportunistic, not relying too heavily on relationships. I think that, I come from a multi-manager background, so you can always see the merit of blending different strategies, and the reality is all of these different approaches will have their particular market environment where they will do better or worse. So I can see the merit in discretionary macro making a comeback now. Interestingly, as is often the case, we saw a lot of the macro houses, either stopping to manage external money or just shutting up shop in the last 3, 4, 5 years, and that's often a sign things are going to improve. Yeah. So the cycles have proven to be repeating again. So I think it is definitely an interesting environment for discretionary, and that's been proven in what we're seeing in terms of manager performance data at the moment. That's not to say that some quant strategies can't do well in this environment.
To me, it's like they're finally right after 12 years, right? The discretionary guys were like, the Fed's balance sheet, all this stuff is causing problems, and the equities just rallied straight up. So I think they got a lot of, you guys aren't good. You didn't catch any of this bull market in equities, and that's kind of why investors flowed out of discretionary.
Yeah, and I think when I started off, spent a lot of time on trading floors in the early part of my career, and people traded obviously with a macro mindset, and macro traders always have that bearish mindset of what's going to go wrong in the world. Right. Whether it's like, there's no reason for bond yields to stay this low. There's always going to be that bias to be short bonds at low yields. There's always going to be that bias to try and pick the top in equities and look for the catalyst for the reversal. So in the same way, it hasn't been a great. It was a tough period for trend following. It was also a more difficult environment for that type of traditional macro in the last decade, and that's obviously changed now.
And along those lines, just having been in the industry so long, what do you see both in the macro, the managed future space, the overall hedge fund space? Like, what's changed the most in the last 20 years?
I think, I think there's some merit to what people have said in terms of, obviously we've learned that some hedge fund strategies maybe, have been things that people learned on trading desks, whether it was carry strategies or momentum or certain things like that were maybe you might have be seen as an alpha strategy at one point, 20 years ago, that are less so now. You're seeing obviously more systematic trading, I would say. I mean, if you go back when I started off, quant strategies were still relatively in their infancy. I remember I started off on an FX trading desk, and there was a guy there running quant models, trend following models, but there was a bit of mystique around it. People didn't really know what they were. It was kind of an unusual approach, trading, buying at the highs of the day generally.
Yeah. What are you doing?
Seemed like a funny thing to do when you're sitting on a spot desk. So there's been more embracing of quantitative strategies. Now, obviously, we've shifted more even into more sophisticated quant strategies with more machine learning, things like that. So certainly there's been an evolution there. I think, but as we've been talking about here even today, it's as much how things stay the same. The more things change, the more things stay the same. Now we're seeing bigger moves in markets like we haven't seen for a couple of decades. And, people maybe aren't prepared for that. People mightn't be, anticipating these kind of extreme moves in commodities, and are scrambling to think about, okay, well, if this is the case, if this is the new market order, how do we position for that?
And I'd say one, which we'll get into later, talking about your firm, but one big thing that changed is the ability to access it through, right, liquid wrappers.
That's true. Yeah, that's true as well. Yeah.
So give us a quick bit on your background at Abbey and putting portfolios of managers together, and we'll dig into how all that works.
Yeah, so I spent just shy of 10 years with Abbey Capital, which is a specialist allocator in the managed futures space. Great firm. Really enjoyed working with the team there. Definitely one of the largest allocators into the space. And the philosophy there is obviously multi-manager. Partially for what I've been talking about, like you have the broad category of macro and managed future strategy. So all of the strategies that are trading in the futures and FX markets, and there's lots of ways of harvesting returns in those markets, whether it's trend following, and that can be short term, medium term, long term. There's short term systematic, relative value trading, discretionary macro, quant macro, specialist FX, specialist commodity trading. So it's all about trying to build portfolios that deliver that overall uncorrelated return profile relative to traditional assets, but also being cognizant of the fact that what you tend to see in this space is pretty large dispersion in performance and low persistence. So what I mean by that is, obviously in any given year you'll have a wide spread between the winners and the losers, but the people who are top of the league table in any given year, that tends to vary year to year. Okay, you might see firms doing well for a couple of years in a row, and then they'll slip down the league table, and then they'll make a resurgence. Why? Because there's something about their system that might have been favored by the market environment for a year or two, and then that changes. The challenge for investors is differentiating, what element of performance is just by chance and just being favored by the environment, and what element of performance is actually, true manager skill. So I think there is, that there is a good case for diversifying within the space. And, a lot of times speaking to investors, people would say, we don't really like fund of funds. We don't like multi-manager except in the managed futures and macro space, because you have that very high dispersion in performance, and it can be tricky to select one or two managers.
Do you think some of that problem with dispersion is just a categorization problem, right? Like under the managed futures umbrella, so many different kinds of strategies, of course you're going to have this big dispersion.
Some of it is, but even within like strategies, you'll still get the dispersion. So even within trend following managers, if you look at, say, the StockChain Trend Index, so 10 large trend following managers, you will still get, once you adjust it all to a common volatility, trying to remember what the numbers are, but certainly it could be the order of 40 percentage points in a given year, which is pretty substantial. And I think it comes back to the point that within trend following, you have a lot of unique decisions to make as you construct a trend following program. Firstly, what markets are you going to trade? How are you going to allocate the risk? What time frame? Is it short term, medium term, long term trends you're going to capture? How you deal with volatility, as we've been saying about. Do you kind of target volatility or not? How you risk manage? How you risk manage in a drawdown? So you've got a lot of different levers that you can pull. And what that means is, and even then breakout versus kind of more moving average type models, and all of these will what you'll tend to find is that the managers will by and large be reasonably correlated, but being reasonably correlated doesn't always translate into being very close in terms of actual performance. So, if you take 2020, for example, more breakout style trading tended to do better in the first quarter. If you go back, maybe back into the last decade, managers with more of a fixed income focus probably did better. If you went to the previous decade, managers with more of a commodity focus did better. And obviously we're seeing the more commodity focused managers having a resurgence recently as well. But, it's easy to say now, oh yeah, I want to be with the commodity managers, but go back 5 years ago, if you were a manager with a heavy emphasis on trading grains or agricultural commodities, it was really difficult, and pretty hard to make the case that, things were going to change at some point in the future. So it's all about saying, things work in a cycle, the world can change. What's working today may not be what works tomorrow. So if you want to build a robust portfolio, it does make sense to diversify as much as possible, while all of the strategies have the same ultimate objective of delivering kind of an uncorrelated return stream relative to traditional assets.
Yeah, it's amazing. Like, was it just yesterday? Yeah, oil down, whatever, $20. Most all trend were losing money there, right? So it's like if you take any one little snapshot, they're highly correlated, often with the same positions, and then can end the year, 10, 15% apart. So
that's right. Exactly. Yeah.
And then did you ever do any research on like 5-year periods or 10-year periods? Did the dispersion come in the longer the time frame?
I think it may do. And I mean, certainly you do have that element of mean reversion. But I think that the challenge with that is if you think about the cycle of allocation, that, people might you go and position a strategy to an investor and say, okay, look at the return profile of managed futures and trend following, and say, okay, that's interesting. And then what to do? They go and pick a manager. Often they'll say, well, who's been the best manager for the last 3 to 5 years, and go with that manager. And then they're reviewing that manager 3 years later. Oh, suddenly that manager isn't the best. It's down at the bottom of the league table. And then it becomes a difficult one to defend to an investment committee or a board or whatever it is. So, yes, that manager may then ultimately have a recovery, but at that stage, the investor has exited. So, I think there's a behavioral element to this that you have to manage for. So that is part of the reason for thinking about diversification in the space.
Yeah, the poster child for that to me is the Wisdom Tree launched their managed futures ETF and chose the Trader Vic index, which didn't go short oil, right?
Okay,
they launched it in 2012 or something because short oil trade had been terrible. Yeah. And then, of course, what's the next trend to happen? 2014, oil crashes, trend makes a bunch of money in short oil, and that they're left sitting there without any gains.
Yes.
So yeah, got to be careful which manager you choose for sure.
Absolutely.
So what were some of the big names you dealt with there? Like in terms of managers?
Abbey is a big allocator. So pretty much all of the main, anybody who's running a CTA would typically reach out to have a meeting. So it's all of the big names to the smaller names. I mean, some of it it's in the public domain. If you look at the Abbey mutual funds, you'll see managers like Graham and Aspect and Winton to FX specialists like PE and managers like like Revolution in Colorado. So it's the whole spectrum, and if you're going to employ a multi-manager, you got to expect the multi-manager to be able to unearth some managers that you're not going to do it if you're not focused on the space. So certainly, I think as a multi-manager, part of the role is unearthing interesting managers. Part of it is the risk management and portfolio construction. So it's not just a matter of looking at who've been the best performing managers for the last number of years or who are the blue chip names. There's not as much value in that.
And hard to believe, right, that Winton, Aspect, and I forget the third one, right, but all came out of that dorm room in Oxford.
That's AHL, yeah. So it's I mean that's one of the things you do see in the managed future space is that a manager or a trader might have worked at a different shop, and I've been influenced by the kind of trading philosophy there, and then spins out and starts to run a portfolio. So I mean, you have seen that kind of philosophy, infiltrating a number of different firms over the years, in the same way like the turtle trading philosophy has underpinned a number of different firms in the US. So those ideas do get passed along the way.
And then David Harding came out, right? Was that 2 years ago, 3 years ago, and basically said they're not a CTA. We're not, right? Stop doing this.
Yeah,
it seemed like it turned on a dime right when he said that.
That was an interesting one, and I think it was, it was probably unfortunate timing. It was around 2018, 2019, and it was at a point in time where we were writing a research piece that was looking at the market environment for trend following and looking at why trend following had been difficult. So there was a lot of people saying, trend following, it doesn't work anymore, it's less attractive, or too much money in the space, it's got too crowded. And Winton's, David Harding was also seemed to be part of that perspective that maybe the returns weren't going to be as good going forward. I think it was maybe misconstrued a little bit in the sense that trend was still going to be a pretty decent part of their portfolio. It was a multi-strat portfolio, but obviously not as much as it had been previously. So it wasn't the case that they were saying trend is dead. It's just that maybe there might be other strategies with higher Sharpe ratios or more attractive features. But ultimately, it proved to be that wasn't the case, because we've seen a bit of a resurgence of trend following since then. So,
and then didn't they flop back to say, no, now we are going back to trend?
That's right. So they transitioned back to a slightly higher allocation to trend following. So that's, I mean, it's interesting when you're in the midst of that, it is a difficult thing to defend. And I, at that stage, I was doing a lot of defending in client meetings, saying it's the markets, it's not something structural with the strategy. It's just that we haven't seen big moves. We haven't had these periods of volatility expansion like we're talking about. We had, we had a measure that looked at the number of markets that were experiencing a 1 standard deviation move over the previous 12 months. And if you looked at that measure for the 55 major futures markets, I think at the end of 2018, there was 1 out of 55 markets. Whereas in a normal, good environment with kind of volatile markets, you'd expect it to be maybe 25, 30 markets might be experiencing that kind of 1 standard deviation move. So that period was, and it wasn't that there was no volatility. You remember 2018, we had a volatility expansion, Volmageddon, was in February of that year. But it was choppy markets. There weren't markets with sustained directional moves. So often people will construct a narrative based on something that seems, seems appealing. And the narrative at the time was, well, there was a number of narratives. One was there's too much money in trend following. A second narrative was maybe markets had changed. Markets had got faster and trend followers were too slow to react. Another narrative was you had the growth of high frequency traders, and they were too nimble and they were eating the lunch of these traders. But you don't hear anything about all of those arguments now, with CTAs having a bumper year. So, what does that say? It's people construct narratives to justify or to try and explain things that they struggle to understand. And the reality is, it's never one or two simple things that are behind the performance of the markets. It's much more complex than that.
That was a piece I wrote once. The problem with alpha, it lacks beta, right? So if it was easy to explain, it'd be beta, and you could just say this is why this happened, right?
Yeah, exactly.
And you left one out of, right? The big complaint was central banks and intervention, and that's all dampening volatility. So
that's right. Yeah.
What it sounds like your take is none of that was really true, or some of it was true, but it's such a mixture, it's hard to pinpoint it.
Yeah, I think possibly. I think certainly what I said about macro volatility could have been a part of it, in the sense that we didn't see big variations in the macro backdrop. GDP was slow and steady, inflation was low. When you get booms and busts in the macro cycle, then that translates into, more or less demand for commodities. So that's the macro side. The second thing is obviously you have idiosyncratic events like we're seeing now. And arguably we had less of those in that period.
Right. It's like it just had a smaller opportunity set. Why that is, who knows?
Certainly the opportunity set was smaller, I would say, for sure. I think the central bank one was interesting because it certainly did, at times it seemed to be correct in terms of dampening volatility. But at the same time, we did see some big moves, say in 2014 in currencies with the euro selling off. And that was at least somewhat linked to European Central Bank monetary policy. So it can be, it can be seductive to say, well, that's the reason for why that's happening, but in reality, it can be more complex, I would say. But I think, at a simple level, the way to think about it is, are we seeing their big directional moves on a sustained multi-week, multi-month time horizon? Yes, we are at the moment. No, we didn't see it to the same extent back then for whatever reason.
Going back, how many meetings would you take a year? How many managers would you analyze and do the due diligence on?
Yeah, I mean, literally hundreds. A lot would depend on if you go to a couple of conferences like Context, iConnections, MFA, those types of events. You could definitely do 50, 60 manager meetings over a couple of days. So if you have a number of those in the calendar, then you're going to ramp up your kind of manager connections into the hundreds. So I think it's definitely part of the skill, part of what you should do. I'll give our Top Traders Unplugged Allocator series a plug here. I've been doing this recently. I was talking to Chris Schelling recently from Venturi Wealth, and he was making that point as an allocator. The question I was posing to him, how do you get better at due diligence? And he was just saying it's just repetition. If you just met one CTA ever, as an investor, you say, wow, that's really interesting. But if you've met 100 or a number of hundreds, then you say, okay, it's interesting, but I know another 100 managers who do this. So is this guy better or worse? So I think there is a lot to be said for meeting a lot of managers, and and it is interesting because people in the industry, you meet a lot of very impressive people, and it's a very tough competitive industry. So you can be really high quality, but still just be middle of the pack in terms of the industry performance or assets or whatever it is. So I think meeting a lot of managers, it's not just a repetition. It is it's thoughtful reflection on what you're learning from the managers as well, and I think experience and perspective is helpful too, because you'll always think back of, oh yeah, somebody will ask you about that manager, you say, oh yeah, I remember that thing they did with their system that year and I didn't really like it, and so, it's always in the back of your mind, whereas that's not something that if you just look at 10 years of monthly returns, it won't jump out. But that's what you learn from those kind of week in, week out engagements with the manager, and that's where the value is.
Any good stories? Like a guy showed up without pants on or anything to a meeting? I'm thinking of that Will Smith movie, Pursuit of Happiness.
No, I mean, I'm trying to think. I mean, you meet lots of interesting characters. It's and when you go to these events and people are, you get all manner of backgrounds, whether it's quants or macro people, or and not everybody is the most socially adept at presenting and all of that, but no meetings to report where people have showed up without their clothes on or anything like that.
And how about what are some of the screw ups guys do, where it's like, oh, you should have done that better, right? Of like, what are some of the table stakes for managers out there, emerging guys? What are some of the things you need to make sure you do when you're meeting with a group like that?
I think you got to show that you're competent and savvy and thoughtful. Sometimes people will say, oh look, we've done the back test and it's got a great sharp, and we're running at 15 vol and we don't expect the drawdown to be less than 10% or whatever. And as an allocator, you're saying this just doesn't seem feasible. We've never seen strategies like that before, so it's probably not the case that this is going to be the first. So I think you have to be realistic. If I hear that somebody's saying that to me, I'm saying, okay, these guys are probably have over optimized their system and they're not really that savvy, and that would be a clear flag. I think there are other practical things that people just overlook. sometimes certain allocators just don't turn over their portfolio very frequently. So there's not a lot of opportunity to add new managers. It doesn't mean that you're a poor manager just because you're not getting an allocation. It's just there might be only 1 or 2 slots in that year, and there's maybe 100, 200 potential managers. So sometimes people seem to get a little bit disillusioned, and you don't hear from a manager for a couple of years, when all you can do really as a manager is to engage, keep the allocator updated from a performance perspective. And if the opportunity arises, and if the opportunity is right, then things might fall into place. So I think it's doing the basics is an important part of it. But certainly, being realistic in the return and the volatility profile and how that's presented is important too. Consistency is important as well. If something that has changed a lot over the years, then that's going to be a more difficult story. Whereas if it's fairly consistent, okay, great, you want to see evolution, you want to see research, but you don't want a system that went from being trend to short term to something else, multiple iterations of the same thing over time. So lack of consistency would be a bit of a flag too.
2 things to unpack there. So one, how do you approach it? How do you view like this needs to come out of the portfolio, right? So all this good due diligence, all this stuff to get them into the portfolio. When do you say this isn't working, you're coming out? Especially in trend, when you could have 5 years of flat that's no fault of the manager, like we've talked about.
No, absolutely. And I think what you have to ask yourself is this outside of expectations and outside of, statistical expectations. So you can have a period of underperformance, and obviously it may be just by chance, or maybe that the markets haven't been as conducive. So I think there are things you can do to address that. Obviously, if you look into the pattern of performance and look at the market. So, the classic example, if you're a trend follower, more commodity focused, trading the ags maybe, and those markets haven't been good from a trend following perspective, well then, unless you're taking a strategic view on that the ags will continue to be difficult, you have no reason to remove that manager from the portfolio. I think there are things that are obvious, reasons for reassessing. If people leave, that's one thing. I think that if the pattern of performance is different to expectations, so for example, if you have allocated to a manager, on the expectation they will do well in a period of rising volatility. Okay, if you have low volatility and they've underperformed, fine. Then you get that period of volatility expansion and they still underperform. Well, then that's something about the pattern of performance that's outside of your expectations that you would have to review. Equally, you can have something positive that's outside of your expectations, in terms of the pattern of performance that could be a reason for reviewing the manager. So obviously, if you allocate via managed account, you'll get a lot more information post allocation, and you'll learn a lot more about the manager. So you may learn something in that situation that you didn't realize, in terms of maybe their gross exposure, or how quick they are to manage to increase or scale back risk. So you could, in theory, learn something at that stage that you hadn't realized at the point of allocation, that might prompt you to either resize the allocation or maybe even remove the manager.
But in general, it sounds like you'd be extremely slow to fire a manager unless something way outside the box.
There's different ways of approaching this, and there's no right. Obviously, there is the model, which seems to be the case of the big kind of multi-strat firms, of giving traders a certain amount of P&L,
and then you're out.
And you're out, and that does seem, it's not a kind of a statistical approach. It's more of a, okay, let's find the things that are working well in the markets at the moment and go with those. You can take then the statistical approach of saying you do a lot of due diligence ahead of time and say, okay, we think there's an alpha here, we think there's a return series that's interesting, but obviously it's going to be variable over time, so it doesn't make sense to remove it just because of a 6-month or 1-year drawdown. You have to size it correctly in the portfolio. So I think if you take that statistical approach, you have to have the ability to stick with managers through ups and downs. And obviously you have performance fees in the industry, so you don't want to be exiting managers and giving up negative accrued incentive fees. So I mean, basically what that means is that you have to be able to find managers that are even better than the ones you've got in your portfolio, if you're going to remove a manager and give up that kind of negative accrued incentive fee. So I think that
seems like a little bit of a perverse incentive, right? Like we have this big loss built up.
It is a bit of a perverse incentive. It is, yeah. But I mean, I mean, that shouldn't be a criteria by itself, but it does tip the odds slightly in that manager's favor, because I say for the manager who you're entering at high watermark, you're going to be paying more for that manager. So kind of on a like for like basis, you have to have a good reason for believing that the second manager is going to be going to outperform. And there's a natural temptation to think they will, because they're probably a manager that have been doing better recently relative to the guy that's been underperforming. But as we know, these things move in cycles. So it's I think the overall lesson is to try and be to try and think statistically as much as possible, as opposed to I think there's a temptation. I'm in the process of writing a paper on this. I'm going to put it out in the next couple of weeks on behavioral biases in manager selection. There's a tendency to say, to start and to see good performance and to justify it and generate a narrative around the good performance, rather than see performance and say, well, let's assume that's just due to chance and try and disprove that hypothesis that it's due to chance. If you take that mindset, you're going to be a lot more skeptical of the narrative and a lot more questioning of, well, does this manager really have a skill relative to other managers?
And what sort of heuristics do you have for that as well? Of like, all right, I'm allocating to this manager. They've had a 20% max drawdown. I'm going to let it go 1.5 that, 2x that. Have any such heuristics?
I mean, it people will have different ones, but generally, you should expect a drawdown of 2 times the vol over say a 10-year period as a kind of a benchmark. In rough terms, I mean, it'd probably be a little bit more than that. But yeah, so it's not just that. I mean, I think it's important to have that stop loss, but it's also about the pattern of performance and what you're learning about the pattern of performance as you're allocated to the manager.
And then on the flip side of all this, the emerging manager. How do you think about the emerging manager, someone with a very short track record? Yeah, what are your thoughts there?
Yeah, I think the emerging managers are difficult. It is difficult because sometimes a manager has been in a larger shop, or they might have been a trader at a bank or whatever it is, and now they're transitioning into a slightly different environment, and maybe they traded a portion of a book elsewhere. So you have to get certainty that what you're looking at in terms of the return series is going to be on a like for like basis, and there might be reasons for believing that won't be the case. So I think emerging managers are more difficult. Obviously, smaller managers, more nimble, they're less capacity constrained, so they can access certain opportunities that larger managers may not be able to access. So certainly interesting from that perspective. But you are taking a different type of risk there. Sometimes, there might be the sense that people are always looking for, okay, who's the next manager, when there might be a guy there with a 15-year track record. Okay, the sharp mightn't be anything, off the charts, but a manager who has proved that they can do that over 15, 20 years, whatever it is, with consistency of approach, that can still be very valuable in a portfolio context.
And to me, like that manager, you can see all their warts, right? They've
right,
lived through it. The other manager has hidden warts that you're going to find out about.
Yeah. And even 2 to 3 years is relatively short period of time to evaluate a manager, because the 2 to 3 years, say between 2016 and 2019, are very different to the 3 years we've had in the last 3 years. So different market environments could just favor a strategy. So that's why I think there's definitely a strong merit to being able to see, 10 years plus of data. It's not always the case. Certainly 5 years is a good benchmark to have. But more, my philosophy would be more data is better for sure.
Yeah, and then more assets, better for sure too, because every emerging guy hates to hear we'd love to allocate you, but we can't be more than 10%, and we only do $10 million allocations. Is that just a brush off, or is that real?
I think it depends. It can be the case for some people. I mean, if you're using managed accounts, it's not necessarily the case. I mean, it can be just institutional constraints for certain allocators. It shouldn't necessarily be the case. If it's more, do they have the appropriate infrastructure, or do they have the risk controls, all of that stuff. I don't see why people should be too worried about being more than a certain percent of a firm assets. I mean, okay, maybe there might be with early stage managers, if you're investing early in a fund and you're accruing more of the fund fees, then that can be an issue. But if it's a managed account, it shouldn't really be an issue.
All right, moving on. Next, Archive. Tell us.
Archive, yes.
Yes, tell us what you're doing at Archive.
Yeah.
How you came up with that name? Yeah.
What's that?
How'd you come up with the name? I like it.
Well, when you start a new firm, you kind of mull it over for weeks and procrastinate, and ask everybody, what do you think it's a good name, and all of that. And I was reading the Stephen Schwartzman, Blackstone's book, and he was talking about how they named their firm, and I think his partner was married to the lady who came up with Sesame Street, and she was saying, don't worry about the name, because we started this program Sesame Street. There was never even a street called Sesame Street. If you're successful, people will remember the name. If you're not, it won't matter. Exactly. So long story there. Archive, it just came to me. It was I was looking at something and I thought, oh yeah, maybe that's a good one, because I always like the idea of looking back into the past for clues to the future. And certainly that's in the kind of the whole CTA approach of looking at the past to see performance, but more than that, just looking at past episodes of history and effectively looking into the archives for clues to the future. So that was it. So as I say, I was with Abbey for 10 years, decided, I wanted to spin out, do something myself. Obviously my skills and expertise is in this area within managed futures, macro, all of my experience going back to the 90s. I started off in FX, and as an FX trader and analyst, and then as a macro strategist. So what I'm doing is working with investors, specifically wealth managers, small asset managers, people who have an interest in accessing the space, but don't necessarily have the expertise in evaluating managers or in portfolio construction in the space. So looking to work with those types of entities, either in terms of assisting on manager selection and manager insights, and portfolio construction as well. So part of my motivation for doing it was, looking at the world, I felt, us in the managed future space, we're always saying, oh, the outlook is good, but I really felt that, there was an interesting opportunity where we are now. Everybody's saying the 60-40 is dead, but what is the alternative to it? And I the markets have actually been, you couldn't have said that the markets would have been this good for these types of strategies a year or two ago. But I do think that we're into an environment which will be favorable. And I do think that there will be demand for these types of strategies. So I think it's a good time to be starting a firm in the space.
Was it driven by Meb Faber's tweet of, he was like, I'm dying for some newsletter service. I'd pay big money for it to give me here's who you need to be looking at in this space.
I hadn't seen that, actually.
I'll try and dig that up and forward it to you. And it's mainly you're dealing for now in liquids.
Yeah, I mean, it's everything in this area, whether it's macro, discretionary, quant, managed futures, trend, short-term, volatility trading, commodities, currency. So all of that in the liquid space is where my background is. And yeah, it's been a space that, as we've been saying, has gone through ups and downs over the last decade, but we're into a better period now, and I do think the outlook is good for the coming years. And I think if I'm obviously based in Dublin here, looking across Europe in particular, there's a lot of money invested in kind of asset allocation models, multi-asset models, and really a lot of these strategies are very underrepresented in a lot of portfolios. I remember I went to a CFA investment workshop in Harvard a couple of years ago, and really interesting event. You meet a lot of interesting people in the industry, and you hear lots of high quality speakers from Harvard. But it struck me, engaging with a peer group of 40, 50 investors from around the world, a lot of people still weren't that familiar with the space. So I do think that there's there's an untapped opportunity there over time to educate more and more people on the macro and managed future space.
Right. It's like I've been doing blog posts on managed futures for 15 years, people. Come on, catch up. And then, sorry, I keep coming back to liquid. So you're talking UCITS, mutual funds, and ETFs on the US side?
Yeah, I mean, not just I use the term liquid alternatives with some people, and it's funny. From my mind, it's just that the strategies themselves are liquid.
Got it.
Okay. I think from a US perspective, liquid also automatically means mutual funds. So it's not just that. I mean, private placement, managed accounts, whatever it is, the vehicle is less important as more just the strategies I'm talking about.
And how do you view that space over in Europe? It seems the UCITS wrapper is a little more constrictive than the mutual fund wrapper. Some of these strategies probably can't get fully what they want done in that wrapper.
Yeah, it seems to be. I mean, there are a number of trend following managers you can access in a UCITS format. Some of them have commodities, some don't. The quant macro space is fairly constrained. So I would say the UCITS set of strategies isn't very extensive. There are some, you can access, alternative investment funds, so kind of like private placement type funds, but in a European regulated structure. So that can be interesting for some people. But I think there's an evolution. The whole UCITS wrapper, it ebbs and flows a little bit. For some people, it's all UCITS, and then you read, well, some people are saying, well, okay, maybe I would rather have an offshore fund or an alternative fund to have the fully unconstrained version of the strategy rather than having the slightly more constrained strategy within the UCITS. So it does tend to kind of ebb and flow a bit. And who knows, maybe the regulations will change over time again.
Love it. And then lastly, how do you like co-hosting or guest hosting? What do you call it? On Top Traders Unplugged?
Yeah, it's been great. I mean, I'd never done any podcasting before, so really great to get the opportunity. So Niels Castro-Brarson invited me on, at the start of this year. I've done a couple with him, and then he's invited me to do this allocator series. So I'm speaking to CIOs and other allocators. So that's been really interesting. One of the, I don't know, upsides or downsides. A lot of the people I've interviewed have their own books, so I've had to go and swat up on what they've been writing about before I've interviewed them. So that's forced me to do that. But yeah, no, it is interesting. I mean, it's interesting speaking to a lot of the investors about the kind of the non-investing challenges as well. Speaking to people like, Sebastian Page runs multi-asset at T. Rowe Price, and a lot of his focus is on leadership and building teams. Or I was speaking to Elizabeth Burton at Hawaii, and again, you think the CIO role is all about making the big calls about where the markets are going and asset allocation, but then there's this other element of managing people, and then there's the whole, the behavioral side of things keeps coming back. How do you cultivate a behavioral edge, which is all about, how do you put the right processes in place to try and avoid the mistakes of, selling out that manager just because it's a brief drawdown as opposed to something structural. So it is interesting. It's the same challenges for everybody, but interesting to hear it from big allocators to get their perspective on what's interesting. I think the what you definitely hear is more interest in also. Well, we're probably biased with some of the people we pick, but certainly, there's certainly that strong sense of that certainly the 40 side of the 60-40 may see more infiltration with alts over time.
Got my brain going. Like, do you see that some of these big allocators make the same mistakes as like a small family office or right? It seems like the larger the bankroll, it doesn't necessarily mean the more sophistication.
No, I think it's true. I mean, that's been my experience in on the institutional asset management side too. That you think it's people won't make those mistakes, but one of the things I think about is everybody reads about behavioral biases and says, oh yeah, I can see how other people have that, and I identify these things, but it's really hard in the moment of making the decision. So we're having the discussion about the manager not to have some kind of bias influencing your opinion about them. So it is, it is really hard, regardless of whether you're a retail trader or individual investor or a large institution. I think the best thing you can do is to be probably more process driven, which some institutions will be. The risk with that is it becomes more box ticking.
Yep.
So I think it's a really tricky balance to try and to be cognizant of those biases, but not just be too process and rigid in your structures.
Right. What's the Jason Buck would say, the art versus science, right? Like there's a heavy dose of art to it that you can't just process.
Absolutely.
Out.
Yeah, no, for sure.
And then it's odd to me that they have these, you'd think it isolate that person, keep them out of the HR and all the people business and just let their brain work on the allocations, right? That's interesting that they're dealing with all that side of the business.
Well, it's true. It's a classic scenario. You know, the guy who's good at trading won't necessarily be a good trading manager, or same from an investment perspective or a research perspective. So, I don't know. It's trying to think. You know, my own experience. I've witnessed both sides of it. Some good people managers who weren't necessarily, strong. Really strong investment backgrounds, and that did work well. So I think it's speaking to some of the managers or some of the guests, it's certainly something that has been a challenge for them that they've actually actively had to work on, because they probably come from more of having a kind of a trading or investing skill background,
All right, we're going to finish up with our "What would you invest in" segment. Give you a few levels. So you got 10K. That's all you got. Where are you putting it?
Yeah, I think if you've got 10K, obviously, you're looking for something speculative. I'm not I've done a little bit of VC investing, and it's something that I'm kind of getting more interested in. So I would say certainly pick something from a VC perspective. Obviously, the digital assets is a space at the moment, but I'm not really a crypto fan. I haven't been to date, but I do think there may be interesting opportunities in the whole infrastructure side of things. So, so that could be something from a speculative perspective.
100K. You're going up to 100K. Where's that going?
I think once you get up to the 100 to kind of million levels, then you're getting into more typical kind of investing and asset allocation. So obviously I'll talk my, I do think we're into an environment of, more difficult for financial assets, probably higher inflation over time, possibly, financial repression. So more negative on financial assets, more positive on real assets, and trading strategies that are favored by that. So that includes everything from, obviously my own, I wouldn't dissuade anybody putting 100K into trend following or macro, but equally farmland, I think, is interesting, and real assets like that are going to stand up over the next decade or so.
And then you sort of wrapped $1 million into there. So we'll jump all the way up to 100 million.
100 million is easy. If you have 100 million, call Archive Capital and we'll construct something for you.
But don't you want to still have some portion in equities? But right, you're gonna.
I think one of the things that's also interesting that you're getting more that's kind of coming on the radar to a greater extent is the use of futures for equity, for beta as well, and combining alternatives with futures beta. So that's something that we're starting to see more in the market. I think that's interesting. That could be something for somebody with the 100K or the 1 million as well. So I'll say the 100 million. I think you're talking into institutional portfolio. You're looking at a multi-strat portfolio in this space.
And then I'll flip that a little bit. So with that 100 million, what's the proper? And it's obviously all depends on the person and the client. But what's your range for how much should be allocated to macro futures type strategies?
Yeah, I think it's as I've been saying at the outset, it's about harvesting different approaches to trading the market. So I think you can definitely have a really nice portfolio diversified across price trend following, economic trend following, or quant macro. coupled with the other strategies in the space. So volatility trading, systematic relative value as well, and then looking at opportunities on the discretionary side, whether it's more commodity focused or more traditional macro. So I do think it's probably hasn't been in vogue for a while, but it sounds like investors are warming to this to a much greater extent. Obviously, a lot of flows have gone into the large multi-strats, and that's a slightly different approach. But I do think, for diversified macro portfolios are interesting. And when I say macro, I'm including managed futures within that.
But 5%, right? Like there's a point where it doesn't even do anything for you.
Oh, you mean it within your overall portfolio?
Yeah.
Yeah, I mean, I would be thinking more like 20%.
Right.
Yeah. So if you're thinking about your 60-40 portfolio and you're really looking at the 40 side, what's the best way to manage that?
Let's go to 40. Why not?
Let's go to 40. Yeah, possibly. Yeah. Some people will want something maybe from an income perspective, and there are other uncredited strategies out there. But yeah, maybe let's go to 40. Yeah, why not? And let's go above 100 and use futures for leverage, and then it gets very interesting.
Definitely. And I think that's the mistake we see a lot of institutional allocators make, and family offices of like, I'm going to try alts and do 5%.
Yeah.
Doesn't do anything. It's not going to move the needle one way or the other.
Absolutely. Yeah.
All right. Any last thoughts before we leave it? Where can we find out about Archive? What's the web?
Yeah, it's archivecapital.ie. And you'll find me on LinkedIn as well. I post a little bit on LinkedIn, starting to warm up a little bit on Twitter. I've been off the base on Twitter.
Right. Come on. Come on in. The water's fine.
And obviously I'm co-hosting a bit on Top Traders Unplugged. The allocator series is there. It's I'm talking to CIOs and allocators, so that's interesting. So check that out. It's
great. You want to come be guest host here sometime?
Yeah, certainly open to it. Yeah.
Done. If you can get David Harding, we'll do it.
Yeah. We'll do our best.
And I forgot to say on Happy St. Patty's Day, go have a green beer for me.
I'll go and have a pint there. Thanks a million.
Yeah. Do they do green beer in Ireland, or that's passé?
We don't know. There's none of that. I think it's Chicago. The river is green, isn't it? But no green beer. It's black and white Guinness.
Right. If you can turn your beer green, it's probably not a true Irish beer, right? It's a little too light.
Probably not one you want to drink.
All right, Alan, this has been fun. Thanks so much. I don't know what time it is over there. Time for dinner?
Coming up to dinner time, yeah.
All right. We'll talk to you soon.
Great. Thanks a lot, Jeff.
Thank you.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts, and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.